I have a bullet list here I'm going through, so try to keep me on point. It's funny, when I have a deadline, like yesterday, my wife said, "Look, you got to do this. You got to be real quick." And I just went on and went on without having anything written down. Today, I have the run of everything. She's not here, and she probably won't be home till tonight. And I I made a bullet point list of things I wanted to cover. And I don't know. I should have did this yesterday probably, but whatever. So you want to review what you thought was going to happen on the weekly candle. Go revisit that. And here's something also you want to do. You need to have a pen or pencil, some kind of writing instrument, and a pad next to you while you're trading. Because on that piece of paper or that pad, you have your weekly analysis, what you think it's likely to draw to. Because here's the benefit of doing that. If you do not have the expectation of where that weekly chart may be reaching for, you might get completely out of a position that's running right for that and leave 30, 40 handles if you're in S&P, or 80 pips in some instances on a forex trade, because you just felt like it was time for you to get out and you abandoned where you thought that weekly candle may be reaching for. When I was a younger man, I learned a very hard lesson doing that month after month after month of knowing where it's likely to go, but growing in my trust to get to the point where I can say, okay, I'm going to leave something on. And how do you do that? Take as much as you can off and leave the smallest portion you can leave on a trade open until it hits it or stops you out. That's the way you get to that trusting factor. How do you get through learning how to hold on to these trades to get to these targets, ICT? Because if I was up a little bit here, my mind would say to me, let me get out of this because it's uncomfortable and I'm scared it's going to turn into a losing trade. How do you get through that? You get through it by holding on to it. You put your stop in a position where preferably it doesn't gap up above your entry, and that can always be a risk. Every one of these markets can do that. So in that regard, stop losses won't work. But barring those instances, your stop loss moved into a position where if it moves up to you and before you entered, or better than where you entered, in other words, if you were short, your stop loss is below your entry, you are sitting in that position there and you have the smallest position open and you hold for it to hit your target and you don't trail your stop loss anymore. You just let it go. And you grow in confidence over months and years, folks. It takes years. These yahoos out there trying to tell you you can learn this stuff in a couple months or a couple weeks or a 1 week boot camp are full of shit. Okay. You can't. You cannot teach somebody how to get a 200-to-1 fucking trade, okay, in a 1 week fucking boot camp. And they're teaching you trading and they're only showing nano lots in their fucking live accounts. Get the fuck out of here. But you're reviewing that weekly candle analysis and referring to that economic calendar. So that way you know the stage is set and you're looking for something opposite to what you anticipate in terms of directional bias on that weekly chart. So in an example, say you are looking at the pound dollar for forex traders. Okay. Oh, he's talking about forex. Oh yeah. I've been tired of hearing about this S&P shit. Come on, ICT. Come on back home to forex. Actually, I am home with commodities, but nonetheless, say you're interested in pound dollar and you think that the weekly candle is going to expand higher based on your analysis on the weekend before the markets even open up. You think that there's reason for that weekly candle to go higher because it's been going higher and it's likely to go up to a specific old high or trade into an imbalance, a SIBI, or a fair value gap that's above price. Okay, I'll differentiate between SIBI and BISI before I close this, because I know some of you are probably chomping at the bit to dial in on the ICT on the wire here and ask me, what's the difference between the fair value gap, BISI, and the SIBI? And could you tell us the difference? And I will. Just give me a second. Maybe longer than a second. But once you have that weekly analysis and that calendar lined up, you now have a stage set for British pound likely to go higher. So you're in a buy model. And then there's a report coming out in the morning for pound as a currency. What you want to see is there a low on the 15-minute candle where sell side liquidity will be resting? Or if that low is really far away from market price, What is that? Well, it's relative to what your understanding about price is. There's no way for me to say it can only be this many pips. That's that gray area that experience is going to dictate. But if it's within, I don't know, 40 pips, anything more than 30 pips, I think is a much more meaningful move. And it's probably not a run for liquidity. It's probably going to just keep on going. But don't use it as a hard rule all the time. It's just a general rule or general principle that you can go by. And why do I use that? If you studied my concepts with the Judas swing in London, where the London session usually creates the high or low of the day, it has a 70% likelihood of creating the high or low of the day. If you are in a sell model, and if you are in a seasonal tendency that's bearish, and it's an obvious draw on liquidity for sell side, all those factors being equal, then you do have a 70% likelihood. Because I see all these guys out there trying to run reports and statistics. ICT said 70%, and it's really not. I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chewing on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0-0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay, that's all bullshit. Everything, all these algorithm is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay. It's New York midnight. That's the opening. Okay. I don't give a fuck. Anybody tells you different. That's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're going to fucking be schooled. So don't talk your shit in your little private little circles, okay, your little fucking webinars, talking all your bullshit because you ain't getting the balls to come here directly. You do it right here, and I will run circles around your motherfucking Mickey Mouse ass. Clown. UK boy. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. Now, here is that point of contention that every student of mine has, even private mentorship students. They want the silver bullet answer that says, okay, here we are. We're at the brass tacks. This is where the rubber meets the road. ICT, lay it on me, baby. This is it. Hear that? That's excitement in your voice. You're talking to yourself, and I'm not in the room with you. How do I know, ICT, that I can buy that fair value gap and it won't go below the low? Are you ready for this one? Ready? You get your pen and your paper? Write down this. I don't fucking know. You don't know. That's why you put a stop loss there. Are you fucking kidding me? Yeah, that's it. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. And then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. Done. Done. How's that fucking complicated? It's liberating. You don't have to know. But if it does happen to you adversely, you know what you're going to do. And if it happens again as an adverse effect and you lose, you're done. You're fucking turning the charts off. You're done. That's your morning routine. You're done. You did your 2 trades. You've lost on both of them. You're done. Or the second one wins and you recuperate some of the drawdown, if not all of it, and maybe go into profit. That's the part that's going to separate all of you from the people that stick with this. Because if you can't accept the fact that you're probably going to lose and it won't change anything, it just takes a little bit away from you. Just like it takes away from your fucking gas tank when you drive your fucking slave job. Okay? It costs you money to go to work, but you don't ever look at it like that. It costs you toll money to get to work, but you don't look at it like that. That's a fucking loss, okay? Your stop loss is getting hit every fucking day. As soon as you start that car up and you're driving down the fucking road, your stops are getting hit. It's costing you fucking money. You got to replace a fucking tire. You got to replace your tires. You got to change your fucking oil. Guess what? That's drawdown, baby. It's all about perception. You're running around with blinders on. You can't do this and not lose money. You're going to lose money, but you have to manage effectively how you lose it and come back from it. So you're going to do one of those 2 things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if we trade down to the fair value gap in that low, if it's less than 30 pips, I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. That's it. Isn't that straight to the fucking point, folks? Okay? You young guys, get to the fucking point. You can't get any more to the fucking point than I'm doing right now. I'm literally giving you IPTA step by fucking step, and you're still gonna fucking complain. Whatever. So what you're doing is you're determining if you're bullish in a buy model, you're expanding higher on the weekly candle, you're waiting for opposing price direction at the time of the news driver being released. Okay, so whatever, like an employment number or an economic number that comes out, you're expecting the algorithm to reprice lower, and that's going to get all the retail traders wanting to go short. That's exactly what you want. That is the green light go you're looking for. You want to see something opposed to what you think the weekly candle is going to do at that time of that report. That's manipulation. That's the trick. That's the broken wing trick that the robin does to protect its little fledgling that's trying to teach how to fly. You ever seen that, a robin on the ground? And you see it, it sees you before you see it, and it starts chirping real loud, and it starts putting its wing out to the side like it's broke, and because it wants you to chase it. And once you get close to it, that fucking wing's perfect. It flies away and it's laughing at you. But you don't see the baby it's distracted you from. Well, the market does that same kind of thing. That's a Judas swing. It leads you down the primrose lane. It makes you think you're seeing something that's valid, but it's not. And it catches people that are offside because they're ignorant. They have no idea what the fuck they're doing, and they're chasing excitement. Just like a predator. They want to chase the thing that's running. Well, when the market runs, you think about what that's done. You have all these people that are neophytes. They're traders that have no idea what they're doing, and they're just anticipating doing something next, but they don't know what it is to do. because they're looking at these candles forming and they have no idea. But when there's an excitement and it moves really, really fast low, real quick, sudden, what does that make? Oh man, I'm missing it. FOMO kicks in, fear of missing out on the move. It's already dropped 20 points. Man, it could go 100 points today or 100 ticks today. And I don't care if I missed the first 30. Let me just get in there right now at down 32 ticks. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay. You're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. Remember month 1 in the core content? That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. And they're rushing into the market. Liquidity. What are they doing? That big drop that occurs. Let me say this. This might not occur in price. And if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things that would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? Because they want to buy it. They have to have sellers at a lower price.